Your ultimate pit stop, Piston Pundit, is here to break down how a quiet gold dispute in early 2025 revved into a geopolitical showdown. The US hit 1 kilogram and 100-ounce Swiss gold bars with a 39% tariff, spiking futures to a record $3,534 per ounce. Switzerland, refining 70% of the world's gold and exporting $36 billion in Q1 alone, pushed back. Swiss President Karin Keller-Sutter's last-minute appeal failed, until Trump shocked markets by scrapping the tariff via social media, sending prices down to $3,407. This high-stakes clash could reshape reserves, trade flows, and global monetary momentum. Lighting the fuse, Trump's high-stakes gold play. In April 2025, the Trump administration set the stage for one of the steepest tariffs ever imposed on a developed nation, a 39% levy on most Swiss imports. Gold was initially expected to be exempt due to its critical role in U.S. reserve management. But Washington trade hawks saw an opening to test Switzerland's reliance on the American market for high-purity bullion. Switzerland refines roughly 70% of the world's gold, much of it recast into LBMA-approved bars and shipped to major financial hubs. For decades, the Federal Reserve has depended on these refineries to maintain reserve quality. The dispute escalated on July 31st when U.S. Customs ruled that 1 kilogram and 100-ounce bars, the COMEX standard, would face tariffs. Gold futures spiked to $3,534 per ounce, prompting Swiss President Karin Keller-Sutter's failed last-minute trip to Washington. This wasn't just a numbers fight. It reflected Trump's $48 billion deficit battle, Utah's push for origin transparency, and Switzerland's unyielding banking secrecy. And if Switzerland's gold dominance is the ignition point, the next gear in this story is understanding why that dominance is nearly impossible to replace. Why Swiss gold is the unswappable engine in the system. Gold might have an ancient allure, but modern gold refining is a precision industry, and Switzerland runs it like a championship-winning pit crew. Its 4 major refineries produce bars so pure they pass the exacting standards required for central bank reserves, including those of the Fed. Alternatives: Canada and Australia can't match Swiss throughput or consistency, while Japan's refiners juggle heavy domestic demand and logistical hurdles. Even if these producers revved up capacity, factors like LBMA certification, higher shipping insurance, and longer delivery times would stall any attempt to replace Swiss supply. But the metal's significance doesn't stop at bullion. Swiss refineries are linked to other precision exports, from high-end watchmaking to pharmaceutical catalysts. In Q1 2025 alone, over $36 billion in bullion accounted for 2/3 of Switzerland's U.S. trade surplus. That dominance grants Bern a unique form of leverage, explaining why Washington's tariff announcement rattled not just traders, but entire industries. Before we delve deeper, do us a favor. Smash that like button and subscribe to Piston Pundit so you never miss the latest on automotive and market power plays. Now, if Swiss gold is an irreplaceable engine, the next question is, how does this tariff ripple through the U.S. economy's drivetrain? The tariff's ripple effect on the U.S. economy. On paper, an extra $80 million from a 1.2% levy, or even billions from a 39% tariff, seems minor next to a $48 billion trade deficit. But gold's role in U.S. financial stability amplifies the impact far beyond its raw cost. Gold trades directly influence the Fed's reserve management, liquidity buffers, bond yields, and the dollar index. A $15 rise in the gold premium can lift yields by 15 to 20 basis points, strengthening the dollar but undermining export competitiveness, a paradox for Trump's deficit-cutting agenda. Political divides add friction. Utah's mining lobby demands strict origin transparency to boost domestic supply, while jewelers in New Jersey and Illinois push for exemptions to keep costs manageable. Just a few Senate swing votes could determine the outcome. Markets already feel the strain. UBS warns a sustained premium could favor the Swiss franc, while JP Morgan projects the Fed might inject $50 to $75 billion into repo markets to maintain stability, a costly move that risks undercutting Trump's broader fiscal goals. And while these economic ripples hit Washington, Bern is already plotting its own counter-moves. Switzerland's leverage and tactical counterpunch. Switzerland is playing a calculated long game. By linking gold tariffs to other high-value exports like pharmaceuticals, luxury watches, and precision instruments, Bern has turned a bullion dispute into a multi-front trade negotiation. Swiss negotiators have hinted that any U.S. gold tariff relief could hinge on easing quotas for pharmaceuticals or lowering duties on industrial parts. But one line is immovable: banking secrecy. Protected by constitutional law and public opinion, Switzerland refuses to dilute its financial privacy, even for major concessions. At home, the gold tariff has sparked debate over revenue use. The center-right pushes for industrial protection programs, while the left favors climate and social spending. Yet across the spectrum, there's unity. No U.S. exemption without meaningful gains. This stance is backed by Swiss refining dominance. Over two-thirds of the world's bullion passes through its facilities. Disrupting this flow would tangle global supply chains from jewelry to high-tech manufacturing, ensuring Bern's bargaining power remains a potent, enduring asset. Which brings us to the critical question: can either side afford to let this standoff drag on? The endgame dilemma: deal or deadlock? Both Washington and Bern understand the dangers of prolonging this standoff. For the U.S., steep tariffs on Swiss gold risk cementing higher premiums, increasing borrowing costs, and eroding reserve credibility. For Switzerland, losing access to the U.S. market could slash revenues and force a rethink of its export model. A leading proposal is a partial transparency deal. The U.S. relaxes origin certification demands in exchange for reduced tariffs, while Switzerland offers limited, tightly controlled financial data access. Advocates say it could trim the trade deficit by $4 to $5 billion, ease gold premiums, and calm domestic political pressures. Yet even this compromise carries costs. Added logistics, insurance, and compliance could leave a lasting $2 to $3 per ounce premium. The bigger question: has Switzerland's prized independence become a liability in today's era of aggressive bilateralism? For now, markets remain hypersensitive, with every leak from U.S.-Swiss talks moving gold prices within minutes. As long as Bern holds the gold card, any quick U.S. win could become a costly long-term bill. And that leads us to the final verdict in this high-stakes geopolitical race. Verdict: gold's high-stakes geopolitical showdown. What started as a minor tax dispute has escalated into a global power play. Trump's 39% tariff on Swiss gold bars has put the U.S.-Swiss trade relationship, domestic political priorities, and the stability of global markets under the microscope. Three routes remain: ease origin transparency rules for cheaper gold, stand firm and shoulder the costs, or rework reserves with alternative metals, each with steep trade-offs. The choice will influence bond yields, currency flows, and how the world views America's fiscal discipline. Now, over to you. Should the U.S. compromise to secure Swiss gold? Does Switzerland's refining dominance guarantee long-term leverage? How might this standoff reshape global trade in the next year? Please share your thoughts and experiences in the comments below. We love to hear from you. Before you head out, make sure to subscribe to Piston Pundit and hit the bell so you never miss our next deep dive into the mechanics of markets and motoring. Thanks for watching and see you next time. You can now check out any of the videos on the screen. There's plenty more to explore.